A revenue growth outlook. So revenue growth for India Inc. declined about 80 to 90 basis points year on year to about 4 to 6% in the 3 months ended December 2024, according to Crisil Intelligence. Now, this is based on the analysis of 400 plus companies that account for about half the listed market capitalization. The total sample set could go to about 750, but the outcome is not likely to change much as I understand, and we'll come to that. The report also says that one reason for this is the construction segment, which accounts for a fifth of overall revenues, which dragged thanks to an extended monsoon and slower recovery. So what's the broader outlook here for revenue of Indian companies, and how are they performing both on top line and bottom line, and what is indeed driving higher top line? I reached out to Pushan Sharma, director at Crisil Limited and author of the report, and I began by asking him what was the most macro trends that he was seeing before breaking it up.
So if we look at the overall performance, we can break it down into three parts. There is the construction, which also includes commodities, investment-linked sector. That's about 38% of the overall revenue. That's been underperforming the overall growth. There are the export-linked sectors, which account for about 20%, one-fifth of the overall revenue. That's around the same trend of the overall revenue growth. And then there are the consumption-linked sectors, consumer discretionary products, as well as services. They are performing better. So they are actually pushing growth forward. So that's the overall, breakdown if we divide into these three parts.
So what's the composite takeaway, Pushan? If, some things are going up, some things are going down. So it could be going down because there is a problem with that industry and therefore is not being affected by the overall demand slowdown that we seem to be seeing.
Right. So the overall, takeaway is that commodity linked sectors, because the commodity prices are going down, those are actually showing a decline in growth. For example, steel, where prices are declining by about 10%, we're seeing that the revenue growth is declining by about 7 to 8%. Coal, again, it's flattish 1% growth. The flip side is that the consumption-linked sectors, things like consumer products, discretionary products like automobile, we're seeing growth of around 7%. On the discretionary services side, we're seeing much better performance. For example, telecom, the revenue growth is around 17%, airline about 14%, hotels about 11%.
And all of this is year on year.
All of this is year-on-year growth. So the consumption-linked sectors are doing well, where there is linkage to commodities and more so the government spending. There we are seeing some signs of slowdown.
And what does this tell us about the demand or the propensity to spend?
The demand, I would say, is still muted. If you see the FMCG sector growth, it's not volume driven. To some extent, it is price driven or product mix related. Even if we talk about automobiles, where we saw 7% revenue growth. If you look at the car segment, we see that utility vehicles, which used to account for about 59% of overall sales till last year, the same time period, they're about 65%. Even commercial vehicles, we're seeing an up move towards the higher tonnage vehicles. So a lot of it is product mix related. Overall, if one were to see that, the overall revenue growth has been declining. If we look at YOY basis, it has been on a declining trend, and it bottomed out last quarter, I would say, at about 2.4%. This quarter, it's at about 5.2%. If you look at the overall revenue growth for all of these, listed entities, and you see that trend over the last, 12 quarters, what we see is that the YOY growth that has been on a declining trend. So if we were to look at the numbers in Q3 of FY23, we were at 16% growth. And then it went down to the range of around 7-8% growth for the next 3 quarters. And now we're in the range of around 6% growth. So that has been tapering down. But in all probability, it could be a bottom, and we should be seeing some better prospects as we go ahead, because the commodity prices are lower, and that will give companies some flexibility in terms of what they can offer to the customers.
So you said telecom revenue, for example, was up almost 17%. So what explains that?
That's because the pack prices, they have increased. So from July onwards, we've seen anywhere between 12% to 25% increase in pack prices. And that's what is actually supporting growth.
So as an overall, again, if you were to, apply that to other sectors as well. So how much of all of this is because prices have been raised and or because of inflation?
So Where we're seeing growth is largely on the consumption side, right? So if we talk about telecom there, 70% growth, like I said, is largely price led. Airline, again, the 14% growth, a large part of it is price led, although volume is contributing to some extent. Automobile, we're seeing growth of around 7%. Again, a majority share, more than 50%, is price and product mix related because the volumes other than two-wheelers are quite subdued. FMCG, again, we're seeing overall growth of 7%. Here too, the volumes are quite muted. In fact, the HUL has just come up with his results today. They again are talking about muted volume growth.
Right. So to go back to construction where we started, and what's your sense on what the next few months, and this is a broader outlook question as well, is looking like? That's one. Second, is construction as a whole, is it stable? Is it growing? Is it not?
So, if we just talk about construction, the key parts of the construction segment are steel and cement. The demand for steel is still, I would say, moderate to good. We're seeing high single digit growth in demand. But the pressure here we're seeing is in terms of cheap Chinese imports. China has an aggregate production of around 1100 million metric tons, and it is currently overproducing about 120 million metric tons. So there's an oversupply, which it exports to the rest of the world at cost or slightly above cost, in some cases even below cost. So that's on the price and demand dynamics. In terms of cement, if we see, a bag of cement used to cost about 400 rupees, per bag, which was in Q3 of FY24. The same is about 350 rupees in the quarter that just went by. So there's a sharp decline in price there, and that's largely because of price war that we're seeing in that market. So if we keep aside these, dynamics of price, supply, and demand, if you just look at what is really going to drive growth going forward, a major element here is government spending. We've seen that the government spending had been slightly subdued over the last 9 months. We're expecting that to pick up. And overall, that should bode well for the construction segment.
Right. Thank you so much for joining me.
Thanks a lot, Gaurav.